Hello, everyone. Good afternoon. Today on the final bar, my guest is David Settle from Market Scholars, joining us from Utah. We were talking before the show about the smoky experience of the West Coast right now, and again, we're hoping everyone's able to weather this whole weather situation okay in this part of the country. The market's giving back some of the gains from the morning, gapped higher, but really sort of rotated lower, sort of after Apple's press conference earlier today. Overall, the question is this the pause before further upside or potential for further downside? Ladies and gentlemen, this is the final bar. Hello, everyone. Good afternoon and welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at these markets together through the lenses of technical analysis, investor psychology, behavioral finance, all the tools we can bring to bear to try and make sense of things. You know, as trend followers, the game is, as always, identifying where the trends are and trying to anticipate when there are inflection points, when there are changes of trend. So my toolkit tends to be a mix of leading indicators and lagging indicators. Leading indicators, which tell you to start paying attention to potential reversals, have systems and techniques that put them on a watch list of potential trend reversals, and then a set of tools that confirm when the trend has actually reversed. And I would say right now where we're at with a lot of asset classes is the initial warning signs have triggered the validation signs, the signal that a top is in for stocks, a signal that a bottom is in for the dollar, a signal that new highs are in store for gold. Those are all things that could happen, but I would not say we have seen the confirmation that any of those situations have happened. So we're left to sort of dig under the hood, look at breadth and sentiment and other techniques, individual stocks and themes to try to see what we can see. Now, we have a lot of fantastic guests on the show. It's one of the best parts of the final bar is the quality of people I think we're able to bring through. I'm excited to hear from David Settle here in a little bit today. Tomorrow, we have Pat Saresna joining us from the Market Huddle podcast. And then on Thursday, David Auerbach from the Daily REIT Beat talking a little more about income investing. Next week is going to be a very good week. On this show, we have Tim Brackett joining us on September 22nd. We also, earlier in the day, have Introducing StockCharts ACP, which is our latest special event, Unleashing ACP, the advanced charting platform. It's the newest feature set of StockCharts.com. We just talked earlier today with Larry Williams. I've spoken with Ralph Acampora. We've met with John Murphy, Martin Pring, Arthur Hill, David Landry, many, many others. Recording some great content that we'll share with you on that episode next Tuesday, but also Chip Grayson and I from the management team just sharing the features and potential that resides in StockCharts ACP. So that's coming up on September 22nd. Let's get to our market recap. Wanted to start with a quick survey question. I did a quick candlestick quiz for all of you, and it's important to brush up on some of these patterns, especially when we're in an environment when you may see them. And so we tried to sort of lead a little bit. The question was, during a downtrend, you see a small real body, no upper shadow, and a long lower shadow. What candle pattern is this? If you have to know the language of candlesticks to understand the question, but basically the real body shows the difference between open and close. No upper shadow means we opened and closed near the top of the day's range. Long lower shadow means we traded a lot lower and then came up. And that is indeed, as 2/3 of you answered, a hammer candle. All the rest of those answers are incorrect. Hanging man, shooting star, inverted hammer. The one that's maybe closest is hanging man, but that actually would happen in an uptrend. So the key is during a downtrend, I always remember you hammer out a bottom. That's also a reversal candle. If you see it in an uptrend, we actually call it a hanging man. As always with candlestick patterns, I pay less attention to the names and much more attention to what they mean, what they represent, and what the conclusions are. So that in any environment essentially represents indecision. It represents the open and close being relatively similar and in general suggests a reversal of the previous trend leading up until that point. Let's continue on with our market recap here. So as I mentioned, stocks coming off, going, really in the second half of the day, really peaked out just below 3420, but came off, settled in around 3400. This is after a little bit of a rally in the last 15 minutes or so, but overall finished a little weaker than it spent most of the day, a little higher. The NASDAQ certainly led the way higher, up 1.2%. And technology third on the list of sector leaders today. Mid and small caps, I think, notably finished the day flat, essentially, right around the zero level. So while stocks finished a little more positive in the form of the S&P, if you look at mid caps and small caps, a little weaker. And again, bigger picture, market tops are not a moment, they're a process. And I think one of the key components of that process is weakening breadth, especially in mid cap and small cap, in a day like today sort of fuels that fire a little more, I would say. Continuing on to other asset classes very briefly, and then let's look at some charts. The TLT bond prices finishing down about 0.25%, almost finished flat. And then again, the last 15 minutes, we saw a bit of a divergence away from bonds into stocks, and 10-year yields up to about 68 basis points. Gold and silver finished a little lower, oil up today, but energy stocks still down pretty good. So it's a good reminder, to always remind people it's very easy to get caught up in a simple narrative. Oil does X, which means this sector should do Y. Interest rates do X, which means financials should do Y. And again, if we were in a vacuum and there were two things, that might be a really valid conclusion to draw. But remember, in a complex system, which is what the financial markets are, each one of these is competing with many other potential headwinds and tailwinds at any given moment. The market is a voting mechanism, sort of combining people's interpretations, reactions, assumptions about all those things going on. And that's what we're trying to focus on. We focus on the trends. Having said that, let's look at a chart of the S&P 500, sort of the base case that we've been talking about on the show for, I feel like, a couple months now, as you sort of get this rally into new highs, which is what we've seen. Right when we hit the previous highs in mid-August, we talked about the potential for a top right there. We obviously went a little further, and then since then have come off, and we're retesting this key support level. So as always, you start at the current bar, you look to the left and focus on key support and resistance levels. This is the first line in the sand. Until we break down through the most recent swing low, the trend is up by definition. So based on that definition, the trend is still positive. And I say that because every attempt to break below 3350 and stay there has been repelled, and we've gone back higher. This is a bit of a waiting game until the Fed meeting, the Fed announcements, through the remainder of the week. And I think hearing Powell's comments and the interpretation related to that certainly could be a catalyst for a short-term breakout, or that could be what people are waiting to hear for a short-term breakdown. So again, it's not unreasonable. We'd have a little lighter volume and a little bit of a wait-and-see mode, and that's kind of what price has been doing for the last week or so. Having said that, 3350 and the 50-day moving average just below that, around 3330. Those are the first key levels to break. If that does break, I'd immediately be looking to 3200. That is the peak from June, the low from late July after the breakout. And that would be the next line down. As long as we remain above that, I think you could argue that the cyclical bull market's still very much in play, and higher highs are a decent assumption. If things start to break down through their 50-day, especially something like the XOK, something like technology charts like Apple, which are testing that this week, the S&P 500 remaining above its 50-day, remaining above previous swing lows. As long as those things hold, the trend is okay. But when you see things start to break that, which would mean breadth indicators like this one would start to look a little less attractive. This is the percent of stocks above their 50-day moving average. It's not updated through today's close just yet, so that's going to fluctuate a little bit. But right now we're about 62% of S&P names above their 50. If the S&P goes below its 50-day, if this indicator goes down below 50%, which means more stocks than not have rotated back below their 50-day moving averages after coming from an almost 100% level there at the June market peak, that would really tell you about a change in character, not just in big mega cap names, but on the average stock, on the individual names that make up those larger trends. So that's a key sort of pivotal point I think we're at. I think paying attention to the broad S&P, but also some of these breadth measures that might indicate some potential weakness would be would certainly be a meaningful thing to pay attention to for investors here. In terms of sector movements, communication services, the number one sector today, followed by real estate. Real estate's been up here a couple times. I'm actually really excited to have David Auerbach on the show later this week. David authors the Daily REIT Beat. We've interviewed him before on the show, also on behind the charts. It'd be interesting to hear his take on real estate and potential emerging relative improvement there, because it's a sector that I think a lot of people have sort of forgotten about. Technology, number 3, followed by consumer discretionary. I think that long-term outperformance of tech and consumer, I think, is vital to the broad bullishness sort of theory. If you're bullish, you'd want to see those sectors holding it pretty well. Can the market rally without mega cap technology? Absolutely. Theoretically, that could happen. What are the chances of the market going to meaningfully higher levels with stocks like Apple and Facebook and Alphabet and Twitter and others struggling? I think remote. I don't see that being a great level. So we are certainly feeling, churning around and rotating, but I think leadership and seeing strength from some of those sectors that we have assumed will go nowhere but up, I think is pretty key right now. Just wrapping up this update and looking at some important patterns and signals. Tesla gapping up yet again. This is the number 1 stock based on our large cap scooter rankings, and I encourage you to review the rest of these. We dug into a couple of these earlier in the week. I wrote a tweeted earlier about the FX trade, FCX, FDX, even Fox are all in pretty good uptrends, sort of higher highs, higher lows. So maybe there's something there with the tickers. Also worth noting that airlines all in the top 10, a number of them in the top 10 of improving scooter rankings today. So maybe an interesting theme to dig into there. We need to take a quick commercial break. Back with my guest, David Settle. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, we're going to do another mailbag segment later in today's show. We would love to hear from you and answer your questions on charting, on technical analysis, on StockCharts.com, on market history, whatever you want to throw at us. We'll do it our best to help point you in the right direction. A couple ways to get a question to us. One is via email, thefinalbar@StockCharts.com, or on Twitter. Just tag us at FinalBarSCTV. On our YouTube channel, put a comment below any of the shows, the Final Bar, and we'll make sure we capture all of those and hopefully answer one of your questions later this week. I want to welcome on my guest, David Settle. David is with Market Scholars, one of the founders of that firm, does a great job of educating and empowering investors. David's a fellow CMT whose work I've enjoyed getting to know and following. And David, welcome to the show.
Hey, glad to have you. Glad to be here, or glad to be on with you, David. I appreciate the opportunity. And you were reading off that lineup for your event here on the 22nd, and I'm just like reading all their names on my bookshelf right behind me here. That's quite the lineup. That's a who's who.
It's a decent pack of people we've got. And actually, so we were interviewing Larry Williams this morning, and that's what he said. He was like, I'm excited to be a part of it. I'm really excited that these other people are on here too. It's a pretty impressive group. So yeah, there's a lot of really cool things happening. But let's focus on the expertise of David Settle, because I'm really excited to hear your take on things. We started with your first chart, which is looking at the performance of the Qs versus Russell 2000, tech versus small caps, essentially. Talk us through your take here.
Which you can see, it's been upward trending really since the last recession that we had in 08 and 09, and has kind of gone parabolic this year, and it's gone straight up to previous levels that we had back around the tech bubble, getting up to that 2 level, as you can see, kind of before when things started to peak back then. So then the biggest question that a lot of people have is, was this decline, this 3-day decline, isn't it great how like we've gone from like months pullbacks to like 3 days? Is this a pullback? We go down for a few days, and so that's a big question. You look at this chart, and there hasn't been a whole lot of correction in this at all over the past, in this weekly chart, a couple of weeks. We've come down to the 50-day moving average of this ratio, but not anywhere past that yet. And I think if we're going to really get a good pullback, there's got to be some more breaking down of this ratio during the pullback, where those Qs, those large cap, mega cap names have a little bit more room to fall on any kind of actual healthy correction than the small cap stocks do.
It's interesting. I mean, the conventional wisdom is always, in a strong bull market environment, small caps should be leading, all else being equal. That's sort of what I was taught. But what this
Right.
chart's showing me is that doesn't necessarily be the case. I mean, there are plenty of times, and including this, most recent stretch of the cyclical bull market, small caps certainly it's not a recent, phenomenon of underperformance. Now, we talked earlier in the show about just the broad S&P and sort of trying to understand, thinking about potential for further downside. Walk us through your daily chart of the S&P here. Where are you at?
So again, that question of, did we have enough of a pullback, and what is it going to look like going forward from here?
Yeah.
These indicators I have the RSI at the top, I have the CCI at the bottom, and then the DMI, directional movement index, with the ADX down there. These are all oscillators, just like anything else, and they oscillate from highs to lows, and I think a lot of people think, well, when they go down, then we're having a low point. Well, that's the case. These all went down. The RSI went down below 50 on this pullback. The CCI went down below negative 100. But those are, as you can see, earlier in June, we had a very similar drop on both of those.
Yeah.
And by the end of June, especially. And so, but that wasn't, as you can see, that led to a really good rally coming out of those couple of months. And I think a lot of people think, well, is that the case here? Are we going to get that kind of a rally coming out of that? And if you look down at the ADX, there's a big difference between now and what we had at the end of June. The ADX line, the black line itself, was really low at the end of June when we were coming off of that. So that suggested that we still had opportunity for a trend to develop from that level. I mean, that a lot of the trend up to that point was simply just a reaction off of that, this big low point in March. We just bounced off of it. Now in June, we could really get going on a new trend that, as you can see at the end of August, beginning of September, really matured, with the ADX reading almost up to 50, the positive index getting above 40, the negative index getting below 10. And then you can see the CCI and how bullish that, and the RSI especially at the top. Yeah. And those are kind of classic signals on the oscillator standpoint of maturity of a trend. And so now it's like, okay, have we pulled back enough to start a new trend? And if you go back to January of 2020, we had a little bit of a pullback there too. And a lot of people thought, well, okay, here we go. And we bounced back up. But the bounce back up, that was kind of like the last hurrah. Now, I don't think we're going to have a pullback like we did in March. I don't think we'll ever have a pullback like we did in March for some time. But that little bounce, that last bounce, was kind of like a divergent high point. It was a lower high in the RSI, it was a lower high in the CCI, and then the positive index down below on the green line, and the red line, the negative index, they also formed divergences with that higher high on the S&P. I actually see something like that developing again, coming up here in the next week or two, or surrounding the September expiration, where we get these divergent high points, maybe a move up to 360 on the S&P, maybe not, because we went up so much, maybe only up to around 350 or so. But that's what these oscillators don't tell me, that we've had enough of a drop to say this is the pullback.
It's such a great chart. And David, I just want to wrap up. We have about 30 seconds, but I wanted to hit on your last chart showing the cloud, because it's something we don't show as much on the show. Give us a sense of how this relates to the previous chart. What does this tell you about potential for downside?
Same thing. You got those two lines there, which measure midpoints of different time frames, and we got below the red line at the top, the Tankin line. We got below that 26-day midpoint, which is a pullback, but was it enough to signal like a long-term bounce? And then you notice the cloud span right below that we haven't even touched, which means, and that's usually where we fall down to when we're actually starting the pullback that can lead to a multi-month rally out of that, as well as the down below, how far below the 30-day moving average we are. We dipped our toe under the water, but that's not enough. We need to really kind of push down a little bit lower before we can say, okay, we've got a good solid low point that we can bounce off of again for multiple months and not just for a couple of weeks.
That's a great take, David. I appreciate you talking through it. I'm always humbled by people that appear to be able to use the StockCharts platform better than I do, and I think you're in that cohort of people. So thank you for sharing these charts with us, and thanks so much for giving us a little time together. Hope you and everyone in your family and elsewhere stay safe. All right.
I appreciate it. Thank you.
It was David Settle joining us from Market Scholars. I really like his way of thinking about, comparing now to what we saw in January and February, but also relating that to June. I hadn't paid as much attention to the ADX line, the positive and negative DMI, how that relates. It tells you a lot about the characteristics of more of an intermediate trend versus a mature trend. I thought that was a really interesting take by David Settle. Our next segment is called the Final Bar Mailbag. This is where we answer your questions and help point you in the right direction as much as we can. Let's get right to it. Question number one, why has the XLF financial sector done well historically since 2011 during fall and winter months? I can't seem to find a clear answer searching. Really good question, and here's how I would answer it. So this is basically what you're referring to. The way I got to this, we have a seasonality chart. So if you click on where it says Sharp Chart and you switch to seasonality, you can type a ticker. You can go back up to 20 years, and basically it shows you by month, percent of the time when, looking back at each of those months, when the end of the month closed higher than it opened at the beginning of the month. So we were actually going back to 2001. I'm looking at 20 years of data. And the phenomenon that I'm seeing is similar to what you implied, which is in general, does pretty well in the fall into the winter and then not as good sort of in the first half of the year. You can almost say the second half of the year versus the first half of the year. And I think that's totally fair. But here's what I would tell you to look at. The second thing I would look at is the S&P 500 in general. And when you do that same thing, you look at the last 20 years, you're going to find sort of a similar phenomenon where basically the whole thing of sell in May and go away essentially comes from this seasonal phenomenon. If you look at May through October, it tends in general to be much weaker than November through April, essentially, right? So that 6 months versus the other, May through October tends to be the weakest. And part of that is just the sort of summer doldrums. Part of that is most major corrections have happened in September and October. That's sort of a classic time for any major bear market activity. And so that sort of combines all of that in one chart. Here's the real kicker, though. What you can actually do is look at the relative performance. And if I do XLF on the left and the SPY on the right, hit enter, and we're going to go back a little bit. Here's what you're going to find. Whoops, let me look at the entire data here. So if you look at the last 20 years and you just focus on this performance, what is the XLF doing relative to the broader market? I don't know if I see that dramatic seasonal pattern that you might see by looking just at the XLF. So what I think you're finding, and again, this is my first answer. I'm going to dig in a little bit deeper. I'm making some notes to think a little bit more about this. My initial thought about this is I don't know if you're necessarily capturing financials doing well. You're capturing that everything does well. And I don't know if there's necessarily a pattern of financial outperformance during that period. But that's the way I would start to dig into that using the seasonality charts, especially on the relative side. Question number two, the volume panel is a dizzying array of bars of many different sizes. It hurts my eyes, so I tend to cluster certain areas that look like mountain peaks. Is this a reasonable way to analyze volume, or should I look at each bar one-on-one? So, you're hitting on one of the challenges with volume is it's just a lot of data. This is one of the ways I usually look at volume, which is the S&P. It's the daily volume bars, and it's color-coded by up and down closes, which just very quickly, when you glance at it, you can see a cluster of down days, a cluster of up days, and start to look at trends in stronger or weaker volume. But I also look at on-balance volume, and so I would say, yes, the way that if you want to just look at volume, I think you're doing what you can. I think color coding the volume can be a little more helpful because then you start to see if heavy volume days are on up days or down days. That tells you about the character of the market, whether it's really better buying or better selling. What is really where are people leaning into or out of a stock on these big volume days? That can be a little more helpful. But I would also say, look at things like on-balance volume, things like accumulation distribution. There are chicken money flow. There are indicators that actually look at they string together daily volume reads in a more meaningful way. Sorry. And as a long-term investor, I think that can be it can give you a better sense of the long-term volume picture and not get you so caught up in just the daily flickering ticks of volume. Next question, you mentioned last week one should focus on using log charts. Do you use exponential moving averages or simple moving averages? Is there a time frame when one type of moving average is more helpful? So I am totally biased. I'm glad I am answering this question and not my boss, the founder of StockCharts, Chip Anderson, because we disagree in some ways based on this. The question of which one you use, I don't think there's a clear answer. The argument for using simple moving averages is that most people use them. I've worked with a lot of investors from big institutional money managers down to individual investors trading $1,000 small brokerage account. And I would say most of them, an overwhelming majority of them, use simple moving averages, because most often that is the default indicator that you get on a chart. When you add a chart on the average charting platform, you get simple moving averages. A lot of times you have to dig to find exponential averages, but so the value of using simple moving averages is a lot of other people are using them, so you're seeing what they're seeing. The value for exponential moving averages, if you really want a more accurate representation of the trend reacting to movements in the price, I would say you can't argue with exponential averages being better equipped for that than simple averages, because simple averages take the last 50 or 200 closes and they equal weight all of them. Exponential averages weight them a little differently, and it weights it more to the most recent price data. And so exponential averages, if I was designing a trading system, I would use an exponential average, absolutely, no doubt, which is why the weekly trend model I use is built all on exponential averages. But if I want to get inside other investors' heads, which is why I'm doing this here with the 50 and 200-day moving averages, because I know that's what big money managers are looking at. The very final question. Thanks so much for all the interesting insights you provide your viewers. You're welcome. One question I get, and boy, this is a longer question, I'll summarize. I guess that charting is always all about price and price trend, and never about the background information that might be going on with a specific company. For example, from the traditional standpoint of investing, it could be a good time to load up on shares when there's a good catalyst for fundamental growth or earnings growth, et cetera. But from a charting point of view, would you ever consider any of those variables? So I would summarize your answer by saying, on this show and on StockCharts, we focus on the technical, because what I have found is there are a lot of people that know a lot about companies and what drives good companies and the characteristics of good companies and the fundamentals of good companies, what earnings mean. I have found people are much less equipped to understand trend and understand momentum and understand investor behavior. So at StockCharts, and especially on the show, we focus on trend following, we focus on measuring trend, anticipating trend reversals. My hope is that you don't just use that sort of thing in a vacuum. My assumption, and when I work with advisors as clients, we focus on how you relate the trends and the momentum to the underlying fundamental stories. You have a macro point of view, potentially. You have a view on a particular company like Bristol Myers Squibb. The chart should be a valuable endpoint as part of that holistic process for understanding the investability of the stock, and understanding the company, understanding the price behavior are two very vital components. We focus on the technical. I'd encourage you to focus on your own on the fundamental. We have some fundamental data on our platform, and we are actively adding more and more through different parts of StockCharts. So that is my answer to your question. I hope charts are part of your holistic process. We need to wrap the show. Go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the S&P with volume. I'm using the spiders here. It's a chart I sort of showed you a version of earlier. This is the SPY daily chart for the last year. This is the daily volume read, and it's the on-balance volume. The story here, I've heard a lot of people talk about lighter volume during this corrective period. To be honest, during most corrective periods, if you look back here in mid-June, you tend to have lighter volume through the pattern. That's something that John Murphy taught me early on in my technical analysis journey. And then a breakout ideally is met with stronger volume. Having said that, I think unbalanced volume is a good way to get a longer volume trajectory. We've certainly seen a pullback in the unbalanced volume if it would roll over, which we've not really seen much of a divergence, right? Those pullbacks have not been met by as much greater volume to really change the trend on the unbalanced volume. But any sort of disagreement, if we would rally again and retest the highs on the S&P and the unbalanced volume not confirming that, that could be a really important chart to watch. Chart number 2 is Apple. David Settle was speaking earlier about sort of differentiating a pullback to something deeper. And for me, charts like Apple, I think, are at a really key point to try to differentiate that. You have a stock that's testing trendline support from March and July. It's testing the 50-day moving average. Does that hold or does it not hold? That's what I would watch. And then finally, the relative performance of the Russell 2000 is something to be paying attention to. We are just potentially turning up after a period of underperformance for the last 4 weeks, but I'm looking at that ratio to see, are there opportunities down the captors a little bit? The dollar potentially bottoming. We've talked about the bullish divergence in the daily chart of the dollar. That related to this chart could tell you stronger dollar, stronger small caps. Folks, that's our show for today. Thank you so much for joining us. Thanks to David Settle from Market Scholars. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.